Okay, all right. Next panel. Here we go, guys. What is consuming most of your attention right now? When you look at your work and you think of, like, if you did a time audit, the things that you're working on, what are you spending your most time thinking about and working on right now?
Risk. One word,
Risk.
risk. Risk in the system,
Yes,
risk in our products, risk to this ecosystem.
Paolo Ardoino, everyone.
Paolo? Paolo, did you hear the first question? No. Okay. What are you where is most of your attention going right now? If you do an audit on your daily work and what you're focusing on, what is consuming most of your time and attention right now?
In this moment, I focus in this moment, I'm happily focusing my time on a product. I think that in our industry, the attention to product should be probably 10 times bigger. We always talk about the fact that there should be more adoption, the adoption will come and so on, but the reality is that 99% of the people out there, they don't have the same amount of time that we have in understanding the technology and spending and trying to learn it. So how we can design user experiences and have proper branding and things that are less dog with hats and more things that people relate in their day-to-day lives is what matter the most. And so I try to put myself in the shoes of a person that has a job outside of this industry that needs to be comfortable. Even in Switzerland, like credit cards and debit cards took like 10 plus years to become something accepted because people don't like change in general. So even more so if that change is scary for them because they might lose the keys and hence lose their money. So I try to spend my time on designing products now and being able to communicate them to the broader public.
Willy, did you have any more, or we passed to Adam?
Yeah, I can look. I've been in the space since 2013, and coming from an engineering standpoint, and now we run institutional funds. So for me, it's like bridging from digital to institutional and TradeFi capital, and we've been doing it for 4 years now. Like 2022, we saw this massive amount of like terrible risk taking, Celsius, BlockFi. No institutional practices, and for me as an engineer looking at how do you build these products and take the risk out of it, it's been a learning taking, we work with banks now, we manage a fund with banks, and so how do we create yield safely with institutional practices? How do we lend to platforms like DebiFi and make that robust? So you talk about discrete log contracts, DLCs, and I'm thinking all sorts of things that could break. Right? And how do you get that through the regulators? And like, okay, these guys have seen gold for 6,000 years not break, right? We've seen real estate. We've had 10,000 years of real estate. We understand that, right? Now we're talking about oracles, and that's like maybe 5 years old, and Bitcoin's like 16 years old. And so how do we get to a point where you can take an institutional lens of what can break and all the parts in the system? How do we assess that, and how do we know we're safe and people can use this product without it breaking? And whole, bedlam breaking loose across the world with foreign rails that are not bulletproof.
And it's technical things that are intangible. And I think that's what makes it so hard. You talk about like, you post some type of real estate as collateral. You can go there, you can look at it, you can walk through and say, oh yeah, I understand this building. But how well can somebody actually understand the technicalities of something that's completely software and intangible? And it's hard enough to kind of wrap your head around Bitcoin, let alone all the other things that are being built and constructed on top of that can then be posted in a discrete log. I think it's really, the education burden's really hard, but the auditability of it is extremely difficult as well, to your point, Willy. Adam, let's throw it over to you.
Yes, I mean, looking at the risk factors, Willy was talking about the triggers for the last bear market, basically some very unwise risk practices that cause some big liquidation cascades and are contagion, like one entity going bankrupt, pulling down the next one and the next one. So I think really the lesson people have taken from that is be careful about platform risk. And firstly, you have to know the platform and have a good risk understanding. So we all have our favorite platforms. But there's a platform person sitting next to you with a very solvent platform. But I think ultimately the solution is actually very low tech, which is something the traditional finance learned in the early last century, that you should really put the assets being traded in a custodian that represents the investor and not in custody of the platform. It just is a way to separate the concerns, separate the risks. Of course, some of the platforms do that legally. They would ring fence the assets and so on. So that's another mechanism. And so I think that also feeds into how to bring traditional asset managers into the Bitcoin exchange and trading environment, which is they are used to holding their assets with a custodian because that's how it works in their world, right? And so, that's why Blockstream Capital Partners invested in Kaminu, and Signum and other players are doing the same thing, which is to try and arrange trilateral agreements. So, sometimes it's hard to distinguish between, a risk premium and an arbitrage opportunity. So people will see that they can make a higher funding rate in some exchange in China, and they think that's great until the CEO gets locked up and nobody can withdraw. And this actually happened, and people continued to trade on the exchange while it was happening, and they stayed with the exchange after it happened, and that's not rational. So I think the introduction of trilateral agreements into that will presumably normalize the risk premiums a bit and insulate you to the extent these trilateral agreements hold up from those risk premiums. So I think those are factors. And then, of course, there are other kinds of factors which also, somebody actively trading in the space for some years, I find kind of surprising that people don't take into account, which is the liquidity is not contiguous. You can get stalls and gaps in the market, and that happens on some crypto exchanges. And so, even in the last few weeks, some of them had ridiculous flash crashes. And if you had any kind of limit orders on that got triggered, you'd be upset. And some of the big players, without naming names, actually ended up paying hundreds of millions in compensation for that kind of mistake. So I think there's some maturity to do in terms of providing stronger market making and liquidity assurances in these markets, because it's hard to build on top of something when you can't rely on a smooth market. Some exchanges have hit this problem in the past and tried to shrug it off, but ultimately they're finding that it is actually the exchange operator's responsibility to provide a well-functioning market at the end of the day and engage market makers that can do that. Because Bitcoin is volatile, it can result in huge volume demands. So it's challenging. But Bitcoin is very liquid, but it does have these kind of very high leverage situations, which are tricky to manage, I guess, as one of the drivers.
I want to talk to this because on 10th of October, we ran a fund, we were up that day. We study risk. It wasn't anything to do with Bitcoin liquidity. It was so deep, right? The investors were coming, providing the liquidity buffer. What happened was when that event happened on Wall Street off Trump's tweet or post on Truth Social, what happened was it was right on Friday night, and the risk off event was crypto 24/7, and a lot of people shorted those markets, and we believe they came in from TradFi, and the crypto altcoins markets got wrecked. It was a $20 billion, $22 billion liquidation, the biggest in history, but Bitcoin was just having a normal everyday day.
Jerome Powell, I think it was last week or the week before, said that if he loses the ability to control the short-term interest rate, that they're going to lose control of the system. It was that was my interpretation. That wasn't the exact quote, but it was in that ballpark. And when you look at the emergence of stable coins and what they are going to really bring about, as far as bringing a free and open market to the yield curve, I'm very curious your opinion, Paolo, as you look at the Genius Act, where they're not allowing banks to provide any type of yield on stablecoin issuance. And then when you go outside of the U.S., those types of regulations or policies aren't necessarily put upon anybody that's issuing a stable coin. And then you sprinkle on top of that, you have companies like Strategy that are issuing preferred stock, STRC, where they're trying to keep it pegged at 100, that's paying a 10% dividend-ish. And what that's effectively acting as is somewhat as a competition to stablecoin, to a stablecoin that's backed by Bitcoin and not securitized by treasuries. And so we have all of this activity. My point of the question is we have all this activity that's happening that seems to be in stark contrast to the published yield curve that's being handled by central banks. How do you see this emerging? What do you think this trend looks like as the trend for stablecoins just keeps going? I see you post every week. AUM is now, I forget what it was, 185-ish billion, 82 billion AUM. And so the trend just keeps going higher, and we're going to have more and more stablecoins enter the market, and you have all this bifurcation that's happening because of policy and things like that. But it looks like the free and open market is trying to emerge in the cost of capital. How do you see that kind of evolving in the next 5 years if you had to try to summarize all of that into a way that everybody in the audience can kind of grasp?
Well, okay, so first of all, I would say that we have to split between United States and non-United States. So the reason why twice per week almost I tweet about the market cap of USDT going up is not because we are spending more in marketing. Actually, in 2024, Tether spent less than $10 million in marketing at all. But what is doing the marketing for us is actually the poor decisions of central bankers all around the world, right? So in a certain way, I think is almost sad. So I think a lot about this, right? So the success of my company, especially the main product of my company, USDT, is directly proportional to the success of many economies. Not because I'm taking advantage of them. Thank God there is a solution. I mean, there is USDT, there is Bitcoin. There are solutions to and options for the people living in those countries. But of course, if these countries would do a better job in protecting their citizens, having better monetary policies, not have predatory export of their maybe primary goods in the country, then they would do a better job, and hence Tether would be less successful. So honestly, that is a realization that we have to have. I mean, I wish I could say everything in Tether is growing just because we are perfect in execution. Actually, we are helped by the fact that the world is going towards darkness. And so when you have that realization, you need to think about everything is relative also. So a person in Bolivia is using USDT because they cannot if they hold their national currency they work from January to December, and in December they will be poorer compared to January, and yet they work 12 months. So, but a person in the United States has already the dollar, so what is their point in using USDT that does not even share the yield? But in fact, everything is relative. So someone in the United States should look at something like gold or Bitcoin as their hedge against basically the bad decisions of their own country. Even the United States, that is issuing the best fiat currency in the world, is printing $3 trillion per year, which $1 trillion goes to repaying the interest, $1 trillion goes to weaponry and the new Minister of War, and $1 trillion goes to social healthcare and the rest of what they are spending on. So you can start thinking about the fact that it's not anymore 1970, so people are in debt at the rate of 140%, or compared to the 70s, they were like 60%. So even for the United States, that debt is becoming almost unsustainable, and yet that is the best example of monetary policy, because everywhere else is much worse than that. So you have to put things in context, and so what I think is USDT is perfect for everywhere but the United States. For the United States, we have another product that is aiming to, again, being pegged to the US dollar, but is bringing value to people in the United States as a way to reduce the friction and the cost they still have in the United States. But when I think about the potential of stable coins. Outside the United States, think about Nigeria, the financial rails in Nigeria are between 10 to 30% efficient. If you add a stable coin, it will become 60%. If you go in the United States, the efficiency of the financial rails are already 90%. And so if you add a stable coin, you get to 92, 93, 94%. So of course, the impact that you can have in any specific country with stable coins is different. So there is no solution that fits it all. That's why we have a different product for the United States. But again, what I think about, even until 2022, Tether was making almost little money because interest rates on US treasuries they were very little. But we are now seeing that with the pandemic and after the pandemic, there is almost an escape velocity, not only in the emerging markets and their monetary policies, but and in the inflation in the emerging markets due to their monetary policies and all the global system with the tariffs that are exporting even more inflation in the emerging markets, but also even in the most in the wealthiest countries like United States or Europe, things are going towards a dire situation. Like Europe, in my opinion, is a perfect example of a country that will, or well, like a group of countries that is trying to put their issues under the rug, but the reality is that also the euro does not even have the demand that the US dollar is finding outside the United States. Tether tried to do a Tether euro many years ago, and the peak was 100 million euros. Now the biggest stable coin, euro stable coin is 200 million euros, something like that. Because not even Europeans want the euro, so imagine someone outside Europe. And so the US dollar is really in a unique position, but more and more is attacked by BRICS that want to try to find an agreement among themselves. There is gold that is now ramping up, is almost doing, apart the last couple of days, is doing all-time highs every single day. Tether Gold doubled its market cap in the last month because we are seeing a huge demand coming from Asia and coming from Central South America for Tether Gold. And we are out there promoting Bitcoin as our main product, and unfortunately, is still too complex for most of the people living in emerging markets, developing countries, and they are turning to things that they know the most. That is dollar and gold. And going back to the previous question, something that puzzles me, that actually was puzzling me but makes kind of sense, is that the fact that people should prefer, logically, something that, so if I put in front of you, in front of everyone here, two choices, right? A form of money that is governed by math, or a form of money that is governed by humans. Ideally, everyone should choose something that is governed by math because it's governed by nature, it's governed by perfection. And on the other side, you have something that is governed by someone can change their mind every 2 days and take any sort of decisions. But I always remember my grandma was saying that she trusted 3 people. She trusted her priest, her doctor, and her banker. So people still rely on this system where they need to be handheld by someone else that will tell them what to trust. And so unfortunately, it will take some more time for Bitcoin to be understood by the bigger masses. And we need to keep doing our job to explain that to them, because that Bitcoin will be the ultimate currency that will survive everything and will survive centuries and thousands of years as gold did.
Yeah, so you had part of your question there was the interest rates, and I think Jerome Powell's point that they could lose control. And so I think what losing control for them means is that they are unable to sell the new debt. So from that point of view, the mistakes of other currencies in making the dollar attractive help them sell more debt, and Tether is a very effective and accessible sales vehicle where people in emerging markets are just trying to protect themselves from much worse currencies, basically. So the fact that they're not getting any interest on it is secondary because they have easy access. Now, if they had better access, they could buy treasuries themselves, right? But in any case, that means that sort of cross-subsidizes the US. I mean, that's a known fact about having a reserve currency status, that you're effectively exporting some of your inflation because people globally are using the money. Stablecoins, they have multiple uses. One of them is a better wire transfer. I think that's where Tether started, but now evidently it has more uses of people trying to use it as an inflation hedge. And I think, it's interesting. I think things are getting more dynamic, shall we say, in Japan as well, which is some, a country that's had yield curve control for a really long time. And so, I mean, it's not clear what the US can do about this situation because they have such a large amount of debt that I think they've pretty much realized that the only way forward is to inflate the debt away, which implies intentional financial repression, i.e. that the interest rates are moderately high, but still much lower than the real inflation rate. So that means anybody holding dollars is going to do very badly.
To this point, as you're saying, I'm thinking, so let's say the U.S. goes in and really starts heavily manipulating the cost of capital for short duration money. Today, it's, call it, 4.3% or somewhere in that ballpark. But what if they did start implementing yield curve control and they're pegging it at 2%, and it's very obvious to everybody participating in the markets that the real cost of capital should maybe be 7 or 12 or somewhere significantly higher than what they're paying, as somebody that's sweeping all these coupons into Bitcoin and other things that are hard assets on your balance sheet. Is there a moment where you might look at that and say, instead of backing the stable coins with treasuries, maybe we do something similar to the STRC thing that Michael's doing by being 5-to-1 over collateralized with Bitcoin, but maybe you do it with gold, or you do it with something that is back 2-to-1 for everything that you issue into the market with something that's actually hard, because that market is being so heavily manipulated through yield curve control.
I think we should not forget the role of a stable coin, right? Is to ensure one-to-one redeemability. And technically, we know that, and we believe that long-term Bitcoin will always outperform like the T-bills and all that. But the thing is, history teaches us that, in 1929, in Germany, there was the Weimar Republic, where with 1 trillion German marks, you could buy a loaf of bread, right? So the role of USDT is to maintain one-to-one. So the reason why you use a stable coin is just to have a proxy to the dollar. If with that dollar, today you can buy a big bubble, like a chewing gum, and tomorrow you can buy, nothing. It's not Tether's job to protect that. So that's why also we created Tether Gold, because that is an approximation to something that is a harder asset than the dollar, and is a representation of something that has been with us throughout the history of humanity or modern humanity as a value exchange. So I think, and also regulators will never allow us to do something. I would agree that would be very cool, and in part we have in our balance sheet a little bit of Bitcoin, a little bit of gold. We have the vast majority in US treasuries, and we wish we could provide a little bit more protection to the users, which we are doing, having $30 billion inside our company that are undistributed profits that we made, in order to make sure that whatever happens, we are in this moment 20% over collateralized. While you have banks, and you have to think about this, banks in this moment are lending out around 90% of their balance sheet to people that want to buy a car, start a company, buy a house. And so if you have 10% of demand back in like withdrawing from the bank will go bankrupt. And so instead of having 10% of reserves, we have like 115%. And we are, considered like the evil guys from mainstream media. Like how ridiculous is that, right? So you see all this thing happening, and you then, of course, look at the world and you see why that is happening. Because, of course, if everyone would do like us, if all the banks would be fully reserved, the entire castle of cards would unfold.
Willy, anything you already have released an over-collateralized stablecoin with gold, I believe. That was announced a few years ago.
Well, we have right now around, well, we have more than 100 tons of gold that we own. I think it's around 110 tons of gold we own. We are around the 30th largest country holding golds. Well, technically that is true, but if you remove that, most of these countries keep their money and their gold in Fort Knox. Who knows? Maybe we are second or third.
How do you think? How do you think? How do you think about this as far as because you can't audit it like Bitcoin? Everybody in here knows that the gold token that you're issuing. What are you doing to compete with the BlackRocks in this particular market to show the world that you actually have reserves there? Is there a process or a protocol that you guys are thinking about to really like compete in this market? Because I think that that's a huge opportunity. Knowing what you know about Bitcoin and how it's actually there, you could take all of that and really kind of apply it into the tokenization of gold as you compete with, you know, companies, traditional banks that, you know, say it's in the vault, but I have no clue if it's in the vault. How are you thinking about that from a competition standpoint?
So that's a good question. So first of all, we could say, well, we do a quarterly attestation also on gold. The next one will come out on Tuesday, where we have actually the auditors and the external auditors going into the vault and counting and weighting the gold and then do all that stuff. See, the fact is that we are not, I mean, technically we are competing with BlackRock and these other guys in terms of transparency, because we are putting everything out there. Actually, all our laundry has been out there for the last 7 years, and you know, eventually we are still here, right? Not everyone in the traditional financial industry is still around. So, also, our gold product is, I think, again, is well audited. We are actually working on a full audit also for that and for USDT. Also the realization is that, okay, we need to compete on transparency, which we are doing. I think we are doing also a better job. But at the same time, we are not competing on the user base, right? So if you could see that sometimes you can even have gold. Let's say that you have gold, you are a government, like Venezuela, you have gold, but it's not stored on your soil. And then you have the gold stored in London and you cannot get back the gold. So Italy, I'm Italian, Italy is supposed to have 2,000 tons of gold, but very, very little part of it is in Italy, and the rest, you know, even if they technically have it, do they really have it? Like, as with Bitcoin, we say, not your keys, not your coins. There is not your vault, not your gold, right? So that's why we have our own vault in Switzerland, because we don't trust, we want to verify our own gold. We want to be like Scrooge and swimming. You cannot do that. It's very hard. But actually, in some gold bars, there is still my blood, because I was moving them and pinch myself, and it's full of blood on a few of these gold bars. But
one of the concerns that I saw with the Genius Act getting passed, and all the banks are coming on board. They're doing their own, issuance of a stable coin on top of whatever. The concern for me as a Bitcoiner, I'm looking at all these other blockchains that are the turnkey way to do stable coin issuance. And I'm taking a step back and I'm thinking to myself, 5, 10 years from now, all these institutions are building on top of what I would say is things that are really difficult to audit from a technical standpoint. I don't have the capacity to audit it. You folks on here are some of the most technical people in the world on this topic. And I want to see building on top of Bitcoin, because I know at least at the base layer, it's decentralized, it's actually secure. And so when I see things like Taproot asset protocols, you had your announcement in January, Paolo, and El Salvador, that you guys were moving or trying to move to stablecoin issuance on top of that, which is on top of Bitcoin. You got RGB, you have Liquid, you have, we just had the Arcade thing here a couple days ago. So like all these things for me are really exciting from a technical standpoint, and I think it takes a lot of that technical risk away. But when I look at where all the legacy all the legacy financial institutions are at, that Genius Act gets passed, and I'm saying, oh my God, they're going to build on all of this stuff that is, for all intents and purposes, highly centralized. I can't technically audit it. There's probably 20 people in the world that could probably do it and do it well. and yet they're building on top of what could potentially be quicksand. So I'm curious, with all the technical expertise that we have here on this panel, how do you guys think about that risk as we think of what that looks like in 10 years if people don't start building on top of Bitcoin, or they don't do it on something that, in my opinion, is a very solid rocks, concrete foundation with everything that is potentially going on top of this hodgepodge of things that are out there?
Yeah, so I think one of the phenomena you're seeing with the Genius Act is banks entering the sector, and because of their sort of hierarchical thinking, they tend to want to control the platform. So rather than using an open platform, which is like the internet of money, like if this was about the internet, they would build an intranet. They wouldn't build on top of TCP/IP, and so they are designing from scratch their own blockchain, which is kind of wrong message to take away from it. And if you have a private blockchain, it's basically a SQL database, in other words, right? So yeah, it's pretty hard to audit a private blockchain, or if you can audit it, it doesn't mean much because you've got read-only access to something that somebody's got the only right keys for. So I think, it's going to be more convincing to people, because there are conflict of interests in play, right? So, the Coinbase, the Kraken, the Binance, they all have their own chains, and then you've got, the JP Morgans and all the other new entrants. They also have the tendency to want to build their own chain, but that won't lead to good interoperability, and it doesn't help trust because, if the counterparty is JP Morgan and you're on JP Morgan chain, that's not going to help you. So I think the lesson from the open internet is open protocols win over time, and that for value transfer, you need a neutral, robust, and reliable base platform. So I think ultimately the long-term winner is Bitcoin, and layer 2 is built on top of that. And I do think the confidentiality is a factor. So in 2015, I think, when we released the open source version of Liquid, we had good reception for confidential transactions from 3 audiences. One is, the very technical people who thought it was a fascinating technical construct that this is possible to do. Also a good response from users who liked the privacy, but interestingly, a good response from traditional finance people who said that they like the assurances of blockchain, but they don't necessarily want everything to be transparent for the world to see. We had some interesting conversations in Taiwan recently where, there's been some reports put out showing a dossier of, how many stablecoins each person owns and their transaction history. And it's very transparent unless you do it on Liquid or probably on Taproot assets where there's Lightning involved. And so I think you do ultimately need some high assurance, but still confidentiality for this to make sense long term, because people are not willing to broadcast their bank statements and their wire transfers in a company or as an individual, ultimately.
Yeah, I think if we're talking about putting some of the TradFi rails on crypto rails, it's a bit early, and we can see that even within crypto, the amount of stuff that fails and the amount of hacks. I think some of the stuff that's people are talking about now is putting equities and tokenizing it just as if you tokenize the US dollar, right? And that's proven quite reliable. And say, even if you were to do it on the Solana blockchain, even last cycle, I knew hedge funds that would look for a tweet that the blockchain was down and they would short Solana. And so I see us as Mt. Gox 2013 days, 12 years ago, of Bitcoin when the infrastructure was very, very unreliable. And we've probably got a decade to go on it. So I think, in the previous talk, we were talking about speed and the speed of institutions being slow. That's really important. And it's up to the institutions to be wary and take the same risk assessments before diving in, even though the regulators, who probably do not really understand the underlying technology and risks, are saying, go for it.
And from my point of view, I think the interest is, for sure, it's interesting to think about, okay, well, would be nice if everything was built on top of Bitcoin. But the real downside of using all these different other blockchains is that anyway they are not very scalable, right? So the good thing about, for example, what Liquid is doing and Lightning is doing is that on one side you have Lightning is peer-to-peer channels. They are technically potentially infinite scalable. On Liquid you have a composable sidechain that can be composed through multiple layers and side-side chain, side-side-side chain, and so on. So you can actually build different use cases and all then be settled back to Bitcoin. So that is how you scale out for all the possible future need of modern finance through like real-world assets, tokenize, and so on. So, and I think that when you look at all the other chains, they are claiming super fast performances, and they are trying to push, in order to achieve these super fast performances, they are just trying to go closer to the limit of the speed of light. So, for example, Solana has 400,000, sorry. So Solana is doing 400 a transaction a block every 400 milliseconds, and that is basically what they are trying to push to claim that they are faster than anyone else. But actually, what they are not saying is that in order to get to 400 milliseconds as a block time, then you need to put all the nodes very close to each other, because otherwise the speed of light to connect and reach a consensus is low. So, I mean, I'm not saying that they don't have use cases. I mean, I'm always interested to test new technologies and find new things, but it's important that people understand the trades-off of security and all that, and centralization. So, you know, it's I think looking at every technology with an open mind and understand really the intricacy and what it could bring us, if that really gets to mass adoption, is something that we need to put more effort on.
In short, it's an ad for Bitcoin. As you guys see the world and everything that you're watching and that you're involved in, and you look to the next 2 years, what do you think is going to surprise everybody in here most as you look at what's coming in the coming 2 years?
Maybe gradual and more Bitcoin adoption. I think people have underappreciated the institutional adoption because it has a long lead time because of procedures and policies and training and so forth. So I think that will take hold eventually.
I would speak to the ecosystem within Bitcoin, as I think the surprise will be how slow the road ahead will be, and how long it will be before this entire ecosystem can be robust and proven. Like I think the narrative for the next cycle will be really what is the risk with quantum, and what is the risk to this system under a stress test.
I think I like always to talk about and I know that Adam might have not necessarily the same opinion, but what's happening in the future with quantum, I think will be the most entertaining either wealth distribution. So I think even the Satoshi wallet can be hacked. There is only one chance to hack all the wallets that are where the keys are lost, and so that could be the most important financial redistribution in the world. But technically, on the other side, and before everyone moves to quantum resistance.
Does that make you interested in investing in quantum based on that comment?
I would say that so I think only governments will get that fast. So it would be interesting to understand which government will get to quantum compute so fast to take the money from the existing wallets, and non-protected wallets. But at the same time, it also calls for, isn't that stealing if you are a government and you do that? So that's why I say it's entertaining, because on one side, it's something you could do, and there are only a few players like Google, the US government, probably the Chinese government, that will be in the situation that could do that. But if they do that, then where they cash it out? Like, it's not like they can consider it abandoned property. Maybe in the future, Satoshi will come back and will use those keys. So we'll set a very interesting precedent. So it's like an interesting game theory that...
You're also implicitly saying that you don't think a soft fork with quantum update is going to happen before quantum actually gets to the point that it can crack the keys. I'm curious where you guys stand on that.
But Adam probably will slap me because he understands this much better than me. But the technicality is like, first, so you have two chances, two ways, right, to think about it. Either if you do a soft fork and you add quantum resistant addresses, yeah, great. You can do that, and all the people that are alive will move the wallets there. The problem is the wallets that cannot be moved. So then, on the other option is you do like a fork, and actually you move the Bitcoin in the addresses that you think that are unprotected to something else. But then that is a bad precedent. No, let them steal.
Well, I think that you can add quantum readiness long before quantum computers become practical. So that gives a much longer time for people to move their coins. And I think the quantum hardware is further away than people believe, because it's sort of an industry that is doing blue sky research that needs to market their incremental improvements in order to raise a lot of capital for like expensive physics experiments, basically. But in any case, if it eventually becomes possible, I think the next question is, clearly some coins are lost and those will not migrate to be quantum ready. And then the question is, do you freeze them? Like soft fork out the spendability using ECDSA or Schnorr signatures, or do you leave them for somebody to steal? And that's a kind of ecosystem question, because you need consensus for it. But my bet is you freeze them. So, if we have yeah.
Not that this is going to be hotly debated.
Yeah,
But
it's like,
you're a market
don't
guy.
you want it to be redistributed? In a certain way, they would be put in circulation. And I know, because you are thinking with the trader mind, so you want more scarcity. But the right thing to do would be distributing that way.
I mean, wasn't there some Satoshi quote about people who lose coins are making a donation to everybody else?
I know, but that I think is much more entertaining if they remain to be stolen, because only countries can do that, and is an interesting conundrum.
Filtering was a hot topic.
Yeah.
Yeah, well, I think it'll be an interesting debate, but because it really depends.
For another time.
It really depends, what the ecosystem thinks of that trade-off. But I'm just saying it's technically possible to soft fork in a quantum-ready signature format where you can move existing coins to a new address scheme and still spend them using Schnorr signatures today, but be ready to use a different spend path to spend them in a quantum-resistant way in the future. I mean, one of the problems is the quantum signatures are big and expensive, and nobody wants to pay for that now, which will give them incentive to wait. But if you give them a way to move them so they're quantum ready, well, people might do that because there's no real cost today, and they're ready, they're insured for the future, right? So I think that's the thing.
Just to rotate, just for people's essay, like rotating the keys. If we do the bit proposal 360 that's out there right now, it'd take a year if everybody. These are rough numbers, right? But about a year to just rotate all the keys if people that were trying to rotate their keys were in every single block, because the size of the transactions are so much. It's like 80 times bigger of a transaction size. But yeah, the quantum thing is. Let's do this. Just write down the line. What's the one thing you guys want to leave the audience with as you look to the future of where things are going?
I'll say, you talked about, fiat money and you missed out gold. You talked about fiat money and Bitcoin. There's only three types of money. There's money secured by social consensus, which is the Federal Reserve these days. There's money secured by atoms, and that is gold, 6,000 years. And the future, the only way you can secure money fairly is with energy. And so we've got the blueprint, we've got some volatility to get through. Maybe we'll get there in a decade, maybe 100 years, maybe 1,000 years, but it'll happen.
Yes, I think buy Bitcoin while you can, right? Because, the retail investors had a decade or more to front-run institutional investors who typically have access to, like the early stages of Amazon and things like that. And the treasury companies are here to buy as much Bitcoin as they can and to transform risk so that, people who don't want that risk can get a high interest rate, insured by Bitcoin, collateral. So, I think it's still early, but it's not a good time to be complacent for people who are interested to get exposed to Bitcoin.
I think just do your part in the Bitcoin education. I think that, while everyone should do their own research, but at the same time, again, people base their decisions also on who suggest them to do something, and if you have family friends, you should explain them that there is, that again, the world, I believe, world is going towards darkness, and having access to a form of money that you can control is probably the best opt-out possible. Don't look at price. I think the price is, anyway, would you sell ever your Bitcoin? I mean, no, so that doesn't matter, right? And so just wait. Eventually something will happen, and all the factors or the signals of darkness are out there, in my opinion. So just have some Bitcoin as an option.
Thank you very much.